Bob Lepine from Truth for Life with Alistair Begg were heard daily and weekends on Bible School Radio, 91.3 KDKR Decatur, Dallas-Fort Worth, and on 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, what would it take to get this real estate market back going again? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, interest rates on mortgages may be just one reason why real estate is maybe not what it used to be. What else would it take to get buyers and sellers going again? Today, mortgage consultant Mark Pfeiffer joins me to talk a little bit about real estate. Hey, Mark, what's going on?
Not too much, Mr. Bob. I hope you're having a great day and a great start to your summer.
Yes, sir, I am. Let's talk a little bit about real estate. I know something you like, a little bit about and would like to enjoy talking about. And it wouldn't be a monthly visit if I didn't ask you, how do the real estate markets look? What are you seeing? What are people talking about? What's going on with the markets?
You caught me off guard with that question, Bob. No, I'm just kidding.
Yeah, right.
First question we always address. No, things are good. I would say rates, for the most part, are pretty steady over this last month. They're in that, call it high 6, low 7 range for the 30-year fixed rate. The market as a whole, I just saw a stat, year over year, real estate's up like 6%. It's, quote, air quotes here, down from like 6.4 to 6.3. Like, big deal. It's still a 6% appreciation year over year. So the real estate market's still hot. Rates are still elevated. I think it's going to take a little bit longer, a few more months, maybe into next year before we see any significant movement. But I would say as a whole, things are just okay. Not great, not bad. I'd say just okay is kind of my general sentiment right now.
I saw an interesting report from Redfin that stated that the supply, and we've always talked about this being a supply and demand problem, of homes has grown tremendously. And they're pointing, it's interesting, they're pointing to Texas and Florida. Florida definitely has an issue. And I think it's as we talk about different statistics and what's going on here and there, that, Dallas could be a lot different than Texas as a whole. So keep that in mind. But they were talking about that there was an increase in supply with Texas and Florida leading the way. And, in fact, they pointed to Dallas having a 20% increase in supply over the past 12 months. And a lot of it is due to the inventory of new homes. Are you seeing supply starting to increase in this area? If so, what could that be something that could jumpstart the real estate markets? Yeah,
so to your point, just to just expand on the fundamental problem, it's been, as you and I have been saying and talking about for the last couple, year, 2 years, whatever it's been, it is a supply and demand issue. Like right now, the millennials are peaking at the prime age of buying a home. So the average age is, call it mid-30s, 34 to 36. I've seen different stats, but it makes sense. Families, babies, that'll prompt the home buying process. And the millennials, the curve, the mass of the population is coming of age right now. And what we have right now is a shortage of housing for these folks. And not to mention, and I forget the exact stat, and I'm not trying to get political, but the number of people, immigrants we've had come into the country, tens of millions over these number of years, it's just we're having a hard time finding housing for all these folks. So going back to your question, Dallas, Fort Worth, Texas in general, Florida, I definitely have seen the articles on Florida. And it seems to me when I read it, it's more focused on the Tampa, the Miami, somewhere of that nature. And I have started just since we last did our show a month ago. You're right. I've seen one or two articles where it's got Texas or Dallas or something of that in the headlines. The reality is what you just said, which is the comparison of year over year, the 20%. Well, supply was super, super low. And so now we're just going to be super low, right? So 20% more supply we're still not in a market with a ton of supply. Like, we need more. And the problem is the builders have been, over the last handful of years, very prudent on their part. As soon as they see a slowdown in demand, they'll shut off the faucet quickly. It's not like they learned their lessons from getting scarred in the bubble 10 years ago or whatever that was. So we are still battling a supply issue. While increase in inventory is good, the headlines may say, oh, things are slowing down. More inventory would be good. It would help because there are a lot of buyers. Like, we have so much work done on our side with people pre-qualified. People just can't find what they want for the right price. And that's a twofold issue. But the reality is, it's increased supply, true, from a statistical standpoint, but don't believe the headline and don't believe the panic they try to put behind it. Like, we're still in a super constricted supply market.
What's interesting is I thought this was interesting anyway. What was happening in Florida had something to do with, or some of its supply had to do with the fact that property casualty, home insurance has gone up so much for various reasons. Have you heard anything about that?
Yeah. So again, it's some of it too is supply goes up, and a lot of the home in Florida, especially during COVID, would be second homes or owner-occupied homes. People were just moving from, I know we got a big Northeast constituent in our company that, all moved, relocated from Jersey down to Florida. And to your point, the cost of insurance, for hurricane coverage, all that stuff, the state, income tax certainly has something to do why people go there. But the reality is, I think some of the supply, like, I can't quite figure Florida out. I'm not there, so I can't personally say, here's what I get. But I'm with you. Like, there is a reason why people are leaving. And I don't understand why, because I don't think it's from overbuilding. I really don't. At least not from the articles I've seen. So, Florida's a little bit of a head scratcher. In Texas, so I'll speak to the Dallas-Fort Worth market, what's considered in real estate, a stable market is having 6 months of supply. We're still like 3 months or under of supply. So when you put your home on the market, it feels like it's a long time if it takes 2 months to sell, but it's still a terrific market by normal standards. We've just gotten spoiled over the last 5 to 10 years for what it means to be in a great market. We just think that is the normal.
Let's shift to the presidential elections for a second, because obviously after tomorrow night, when we have a debate, we'll know that we really do actually have an election coming up. It sure doesn't seem like it at all. Are you hearing anything from the standpoint of, if either candidate were to get elected or reelected, I guess reelected on both sides, if they were to get reelected, that it would be a major plus for the real estate markets, or just kind of just a non-event? It would seem to me that, Biden definitely doesn't really do anything that favors any of the markets. And I doubt, I could see Trump trying to get interest rates lowered down to zero again. And I don't think Jerome Powell was ever really influenced by him, is from the standpoint of what he wanted. Are you hearing anything about that?
Yeah, so the good news is my answer, I wouldn't be scared to give you my personal opinion, but the reality is my answer is going to be apolitical in this sense. The election does have an impact on the mentality of a lot of buyers we talk to. The difference is it's not necessarily which candidate, whether it's their candidate. So in other words, oh, Mark, I need to wait. So it just creates this uncertainty, and uncertainty creates, the fear. So I don't know what's going to happen after the election. I don't know if my job's good now. I don't know if my job's going to be there, or I don't know what's going to happen to the economy. So everybody has their own personal beliefs of what their guy will do. But the reality is it's not because, what if so-and-so wins? It's just people can project, but it just creates a fear. And I think a lot of it could be just an excuse to some degree where, home ownership, it's a terrific and wonderful way to build wealth, but more importantly, you need a house over your roof over your head. So whether or not it's their first home or their fifth home, certainly is going to determine. If I got married and I'm renting and I just had triplets, I'm going to be more inclined to go buy a home versus the guy that's got, just normal, stable life in that sense. So I think a lot of it is an excuse. And in terms of Jerome Powell, the good news we have as a country right now is that he's done. He's on his way out. He can't get reelected again. So now he's trying to preserve his legacy. And at this point, it's ego driven in a good way, where he doesn't want to be remembered as the guy that drove this thing to where we had super high inflation, and he doesn't want to drive us into a super deep recession. So he's really doing his best to maneuver the soft landing. I don't know if that he'll accomplish that, but the good news is he shouldn't have the political influence, and hopefully he's doing what's right for the country and to preserve his legacy as a good, Fed chairman.
Yeah, that is the last job that I think I would want. I mean, I
President would be mine, but that'd be the second to last.
You cut rates or you raise rates or whatever you do. There's never been a situation I can think of that the cons are so heavy on both moves. I mean, it's a crapshoot as to what makes sense. Talking about statistics. There was one that came out this morning, and of course, I preface this by saying that, and I think you would agree with this, that the real estate numbers that come out. I mean, there's so many different ways you can interpret what you hear, but this was with new home sales, and showed kind of a big drop in new home sales numbers this morning. Was that anything that kind of surprised you?
No, because again, the difference is, and it depends on whether you look at permits or starts or closings, because there's three different things. Like the permits they pull says, hey, I want to build a house on this piece of dirt. That's going to tell you what's going to close in 12 to 18 months, depending on the build times for these things, versus the starts. So when I start a house, the bigger production guys can get something done in 3 to 6 months, medium size 8 to 12. So a lot of that, when you see the stats today, they say, new homes are down. As I mentioned earlier, builders are quicker to respond to economic traffic or to just traffic in general, sales traffic. If they see that there's not a lot coming on the pipe, they will absolutely push pause. And if it might mean losing a few dollars or having money committed towards a land purchase that maybe they would have otherwise, they might lose. The big builders don't mind losing tens, if not hundreds of thousands of dollars if it saves them millions for making a bad mistake. So at the end of the day, if it's down, it could be down because, again, if it's closings, what was happening 6, 8, 9, 10, 12 months ago when they had to start? So it could just be this little lull before the rest comes online because, again, we're rates right now in the 7s. We were in the 8s. So if you figure if it's closings 12 months ago, they weren't doing the starts. So it's just, the process of building a home, there's going to be a lull, even though this market right now may not justify it. They just can't be at the inventory on the ground. So again, it goes back to and you have a great phrase, and I can't remember it, but stats, you can spin them any way you want. Like all marketers are liars or whatever it is. Like, again, it can actually be a really good thing, but you can spin it to seem as though it's a negative thing. So I'm not concerned. I mean, we still have a shortage, and I think it's going to take a few years, 2 or 3 years, to get the inventory corrected to where we have enough housing to take care of the folks that are in the market right now that want to buy a home.
What's interesting, and it's all about consumer expectations. You've got rates in the 7s, the 6s, but we can all sit around and play with the crystal ball and speculate. I mean, it's a pastime. But at the end of the day, who knows really what's going to happen? But the question I've got for you, Mark, because I know that you talk to so many people and you get a lot of opinions, is the expectation of consumers today is the expectation that I can't wait for interest rates to get back down into the 3s. I mean, are you seeing any of that? Because I mean, realistically, if interest rates were down in the 3s or the 2s or wherever, we would have bigger problems to worry about because that means we're facing an economic depression. So
100%.
What are those expectations just for the layperson who's just watching?
I would say there's about 4 expectations out there, 4 different folks. And I would say, I'm going to speak generically, but I would say it's more the younger generations that haven't been around long enough that think 3 is a normal interest rate. Like, I'm going to wait to get back to the 3s and the 4s. I personally don't see that coming unless, to your point, Bob, something big, really, really, really big and not good happens. So I don't see rates getting back to the 3 and 4s. That's just not normal. That's not how we should have the economy running. So if we're in the 3 and 4s, that's a problem. So the folks that do say that, it's a few, it's not many, but the few that say it are typically the younger generations that just don't realize that was just such an anomaly there. So then you got the other 3 camps, which are a very few. Some think rates will go higher. I ask them why. They typically don't have a good reason. They say, I just think they will. Okay, and that's fine. And look, they might. I mean, we got a whole deficit problem in our country that we can spend another episode talking about. So I'm not saying they won't go higher, but I'd say most are saying that rates are either going to stay the same and sit here for another 12 to 24 months, or that we'll see them go down. I think, my personal opinion, I think rates are going to sit kind of where they are for the next 6 to 9 months. I think the middle to second part of next year, we'll see rates come down a little bit, maybe finish the year in that low to mid 6. But to me, that's a normal, I'm using air quotes here, the normal rates have always been between 6 and 8%. If we get down to the high 5s, that typically means we're going to have a recession or there's problems, people are losing jobs. But I think historically, 7%, we're right in the middle of where rates typically are, unless there's some extraneous, external factor that has some sort of big pull on rates. So I just don't see them going too far, too fast anytime soon. That's my personal opinion. We'll see if I'm right.
Your commentary, you should be on videos with your air quotes. I just want to point that out because you're really into the air quotes, and that's just evident by the reason you bring it up.
I do it, and I'm seeing my hands in front of me doing this.
Of course you are.
I'm holding the phone on the other one, so I'm with you. But you're right. Video would be much more appropriate for how I speak.
And by the way, how can someone find you on? I guess just search your name on Instagram. You got
MortgageMark.com, buddy.
You've got some very very funny videos. So I was.
For social, for all those listeners, I'm not trying to do a shameless plug. This is just a PSA, a public service announcement. My girls, I have a 14 and 10-year-old girls, and I got women in the office. They're all in their young 20s. I'm basically their puppets. So if you want to see a professional look a little silly, find me on Instagram or any of those, just Mortgage Mark, and my gosh, you'll have a good time laughing. My wife will tell me, I know we're getting rabbit trail, Bob, but Caroline comes, I'll occasionally come home after a video gets posted, and Caroline's like, that's not good. I go, honey, the people love it. You give the people what they want. I'll dance around like a silly clown. If it gets some eyeballs, sure, I'm shameless in that respect.
Of course, she is the only sane one in your house.
She is. 100%, buddy.
And 100%. I got the same issue at my house as well. Once again, mortgagemark.com is Mark's website. What's interesting is that, and I think you're so right on this, is that depending on what generation you're in, because I always love to get the quote by someone who's in their 70s or so. Man, I remember when I was paying 18% for a mortgage rate in the 70s.
We're glad to have it.
And yeah, exactly. No big deal. But I looked up a statistic, and just for those who are hoping it's going to be a lot lower, the average rate since 1971. And if you really look at it over a time span where they were really high, they got down to really low, they're hovering around the middle, 7.41%. And it's just interesting to watch where those rates are going to settle in and call home for a bit.
And here's what I agree with you. And this is the part I was having a conversation yesterday with a gentleman that he's like, I might wait. And I said, look, man, do what you want. Like, buying a home is not like buying a stick of gum and it's an impulse buy. Like, you got to want to buy the house, right? So part of the reason why we have a tight inventory is people are sitting on these 3 and 4% rates and don't want to get rid of them. I respect that and I understand that. But here's what happens. People are born, people die, people get married, people get divorced. People get job reload. So over time, those external factors are going to force people to move, force these rates to go away, and all of a sudden it kind of opens up a little bit more of the transactional piece of real estate that we need to happen. But to your point about buying, I told the guy, like, we might wait till rates get back in the 5s. I said, no, I totally understand that, no big deal. I said, but question for you, I said, how many other folks do you think I talk to that say the exact same thing? And he kind of thought for a minute. He's like, yeah, probably a lot of people. I said, yeah. And I said, so if you go out there and you're having a hard time finding something right now, and rates do, let's just pretend, snap our fingers, in 6 months are back in the low 6s, 5s, it doesn't mean more people are suddenly going to sell their homes. It just means more people are looking for the existing inventory. And again, it goes back to our very opening statement of supply and demand. As soon as rates go down, more and more folks are going to come back out because they can afford it or it's more palatable. But guess what? The home today, if you buy it today, you can refinance your mortgage a year from now. The home today, if you buy it at $400, a year from now, it could be worth $420. So I always tell folks, buy when it's the right reason. So I'm not saying go out and buy a house because you should. The reality is, if you want to, don't be scared of the rate. It's not forever. When rates go down, you can refinance. If rates never go down, that means you're getting the lowest rate you're ever going to see today. So there's no reason not to buy if you're in the market for a home. I would not be scared of rates. Rates will eventually go down. If you can't afford it or it's not part of your financial plan, I get that. But just don't be scared of rates, guys. They're not forever.
So, not to put you on the spot, this is a random stat that just a question that came to mind. What do you think is the percentage of available real estate owners? Okay, we'll just call it the collection of people who would buy or sell a house, who own one now or whatever, and that have that sweet spot. They've got that mortgage from 3% to 4.5%, that just go, I can't afford to let this mortgage go because it's just so great. What kind of percentage do you think of homeowners are out there like that?
It's large. I've seen this, and it's part of my weekly videos I'll do, and it's in there multiple times. So now all these charts kind of fuzz together because some show people under 4%, some show under 6%. But that's
a lot smaller than I thought it would be.
Yeah, it's a large percent. So I think the stat, so again, this is me just off the cuff, I want to say close to 40%.
Oh, 40%. Okay.
Are free and clear, no mortgage.
Okay.
So when you figure 40% is free and clear, of the people with mortgages, I want to say it's like 50% or underneath that 4 or 4.5, like some ridiculously good rate, and they're calling it the lockup effect, where people don't want to get rid of it. And even if you want to buy a new one, a lot of folks may keep those for rentals. So that's the piece that says, like, even if and when divorce, job, reload, et cetera, it doesn't mean that house may be hitting the market. It just may help from a renter standpoint. So, but it is a large percentage. And you're right, like very few people, unless you bought in the last 2 years and gotten these 5, 6, 7, 8% rates, chances are most anybody that had a mortgage, unless you're under a rock, probably had something under that 4% range from years past if you owned a home at the time.
Great information, Mark. Once again, mortgagemark.com is the website for information about Mark. And hey, Mark, we'll talk with you next month.
Always good to be here, Mr. Bob. Appreciate you.
Take care. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Listen, if you have not done so, take me up on the risk assessment survey that we've got at the website. What that will do is tell you what your investment risk level is. There's 4 different risk levels, and what I do is I put together a personal assessment for you. It's not that long, but it will give you an idea of what you're up against, and then you get the piece that I wrote on this process. If you don't get the risk level right, you're going to have problems. And if you're not in the right risk level right now for you, you could have some really big problems. So I invite you to go. It doesn't cost anything. There's no obligation. And we keep everything very confidential. Actually, there's really nothing on there that is confidential. But go fill it out. It takes you maybe 5 minutes. Send it in. We'll get it turned around for you in a couple of days. And I think that you'll really like it. There's a lot of people who have done that. And also, one other thing, too, I want to make sure that you know about is the podcast. We do podcast every program. Go to where you ever consume that content and follow the site. Hey, this is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.